Hey everybody, Boris BK Forex. Welcome to our weekly technical review for the majors for Euro dollar, dollar yen, and pound dollar for July 9 to July 13, 2018. No power in the dollar is really the theme this week. The dollar just simply could not get any traction to the upside, despite the fact that U.S. data was relatively good, not great. We still don't have any kind of inflationary pressures, which is perhaps one of the reasons why the market is concerned. But the much greater reason, of course, the market is really concerned is that essentially investors are much more spooked about the threat of trade war than they are excited by the generally decent U.S. economic growth. The fear here is that the trade war is going to completely destroy growth in the second half of the year, and we could be, in effect, be peaking as far as growth goes, at which point, by the way, that means that the Fed effectively could be in for a policy error, tightening too much into potentially a very negative contractionary environment. All of this, of course, is very speculative, but essentially that's really what the market is telling us as far as the price action goes. And as far as the price action goes, we're basically seeing a very, very solid bottoming out in the euro around the 115. The levels remain relatively the same in all the major pairs for the last couple of weeks, but we're seeing a much more different tone to the upside for the anti-dollars and a much more clear tone to the downside for dollar yen. So euro dollar really holding that bid at 115, 118 remains the key resistance to the upside. Dollar yen now really struggling with this 111 level, and we're going to take a look at the charts here, and we'll see that becoming a very, very negative technical construct for the pair. And cable really is a very idiosyncratic trade because obviously it's a trade on whatever is happening in Brexit, but technically looks like it's ready to run. I mean, it looks like a horse ready to bolt out of the gate. So we'll look at the charts in just a minute. Meantime, the calendar this week is much more sedate than it was last week. Not really any serious market moving data as far as the majors goes. Germany has trade balance data. UK has trade balance and industrial production. None of it is going to be of any serious material impact, although we are relatively bullish the UK data. And the thing is that if we get the positive political halo with strong UK data, that could be the combination that really takes pound to the next level. For the US, the main focus will be inflation. And that should be actually kind of interesting because we're sort of bullish dollar on inflationary pressures. But remember that oil is a non-core component of US PPI and CPI, meaning that it really isn't counted as the core component, which means that CPI itself, without the very strong impact from wages, may actually be relatively flat. Market is looking for 20 basis points on the CPI ex food and energy. And if that stays that way, it does put us at around a 230, above the 2% level on the CPI, but certainly hardly a runaway train as far as inflation goes, and nothing there that really makes the Fed more hawkish than it already is. We finished the week on the U.S. side with University of Michigan Sentiment Survey. That should be sort of very interesting here because if you see the first inklings of consumer concern, that's where it's going to show up. If Michigan is showing some kind of a wobble in sentiment, that could translate into perhaps lower retail sales, and that certainly could spell a slowdown in the second half of the year. So all of these factors really swirling around the dollar. It's really a matter of doubt on the political front rather than any kind of negative economic data that's affecting it. But in the meantime, very much reflected in the charts. Let's look at the dollar yen here. You can see that the 111 level now is a failed level. We essentially couldn't take out the 111 highs all of this week. Couldn't even take out post and the non-farm payrolls, which were relatively decent. And as you're looking at the structure right now, we're basically setting up a situation where we have a series of lower highs with a potential to break to the downside. The 110 level looms very, very large. This is a daily chart. This is actually this is a very, very long moving average, 500 moving average, and you can see that the 110 is very much the support area here. The market, to me, feels like it really wants to probe the 110 at the beginning of Asia trade next week, maybe even as early as Monday to you guys in Australia. We'll see how well it holds over here. The key support in dollar yen is 109.50 and really 109. A truly negative sentiment shift would break the 109s and really put a cap into this whole recovery rally, which has so far not been able to take out this very key high over here. It's really been kind of a failed recovery rally off of this. Looking at a longer term picture though, it still looks very constructive for dollar yen. You can't really dismiss the fact that it's in an uptrend, and it could very well just be churn. So if you have a longer term bullish bias, this probably represents a very decent buying opportunity for you. But in the very near term, it really looks like the flows are to the downside, and that's the key concern for anybody who's trading for the next 48 hours. Eurodollar, on the other hand, look at this very, very clean bottoming out process. A strong move to the upside. The perfect trade would have the euro close at the day's highs, but we're still trading relatively decent. It's almost at the day's highs. The most interesting thing here, as far as the euro structure goes, is this ECB massive negative candle. So this was the candle that broke the back of the euro when ECB decided they're going to be much more dovish than the market thought. The 1850 is the high on that candle. What would be super bullish is if we completely envelop and take out the highs of this candle, because that typically these type of candles have continuation. The fact that we didn't have much continuation, and the fact that we can envelop this candle in a full upside takeout would be extraordinarily bullish and suggest the market really wants to take the euro perhaps back up to the 120s. So to me, the near-term bias in the euro, even in the very, very near term, the next 100 points up to that resist point looks to be very strong to the upside. If you look at the 4 or 5 prior days, we're just trading higher lows, higher lows, higher lows. They're just buying it up. It looks ready to bolt. Same thing with cable, surprisingly enough. Cable is formed in a very nice V-shaped bottom. As I said, this is very much open to idiosyncratic risk. But if you sort of close your eyes and make a blind faith effort that they come out with some sort of a small, some sort of a soft Brexit compromise on a Theresa May cabinet meeting, then that creates a very powerful move back up. Cable acting very similar to euro in a more mild fashion. It's really 34.40. This is the candle that broke cable's back. If we can retake that, that presents a very bullish situation for cable. So after a very, very strong sell-off, we're seeing sorry, all my trades going off here at the end of New York trade here. We're seeing some very constructive trade to the upside, but I warn you that it's really headline risk that could just completely upend this move. Of all of the anti-dollar moves right now, the euro looks the strongest technically, and it looks ready it's ready, wants to go to the 1850 level. We'll be watching all of these trades very carefully at the beginning of next week because it looks like anti-dollar trade is very much in play. Wish you guys the best luck, the best trading. Boris, over and out.